Hey everyone, welcome back to the Milwaukee Real Estate Market Update. We're covering what happened in December 2022 and how it impacts your real estate decisions. Teaser, this month we're actually going to review what happened in all of 2022, as well as our predictions for what is to come in 2023. I'm here to give you what you need to make the right decisions regarding your real estate. Should I buy a home now? Should I be selling? Is the housing market about to crash? If you're new to the channel or returning because you found value in our previous videos, it would mean the world for me if you could just take a second to subscribe to the channel. I'm Ty Ash with Houseworks Collective and Compass, your local real estate expert. Let's dive into current events and how that might impact us here locally in Milwaukee. We'll dive into inventory. So a lot has changed in inventory from the beginning of 2022 versus where we just ended the year. 2022 active listings nationally started around 375,000 homes, and we just ended the year right around 750,000. A 200% increase. This is the headline that you're most likely hearing from the media, but as always, it's important to remember where inventory has been historically. Here on our Fred chart, which we'll pull up on the screen, you can see where we just kind of ended the year, where we started the year, but you can actually see in December 2019, we were going into 2020 with just over 1 million homes. At this time, we were already starting to see a dip in the inventory relative to the 2 to 3 years prior. Overall, not enough inventory out in the system right now. There already wasn't enough back in 2019, especially with the upcoming millennial home buyer demand. As I've highlighted before, it's a different story for our market here in Milwaukee. Active listings started around 3,700 homes, and we just ended the year right around 2,900, a 20% decrease. So as you can see, big inventory growth across the nation, but we're actually seeing even less homes to end the year here in Milwaukee. I'll pull up this Redfin chart, which kind of shows the year over year Milwaukee Metro active listings at the top and the change in percent over time on the bottom. The black lines are the 2022 statistics. You can see that we're running way below the last 3 years of inventory, with the actual number of homes available dropping in almost every case each year. The bottom half of this chart is showing some of the biggest declines in active inventory, both versus last 3 years and versus the beginning of 2022. Now, why is that? New listings. On this second Redfin chart, you can see on a unit basis, we continue to run lower than the last 3 years with new listings coming to the market. Then on a percent change basis on the bottom part of this chart, you can see from June, about in the middle of the black line, we've been tracking between down 15% and down 30% versus last year on new listing activity. This is the number one thing driving home price appreciation in our Milwaukee metro area, regardless of what has been happening with interest rates. The scarcity of this inventory, specifically new inventory, while maintaining strong buyer demand in our area and low days on market, has essentially impacted seeing us still having low months of supply. Other media, stories you're hearing out there are regarding foreclosures. So moving on to this category inventory and what impact it might have on our 2023 inventory levels. This month's update is mostly focused on recapping the data from 2005 all the way through the end of 2022. Here's a chart from Adam Data. The headlines will be broadcasting foreclosure activity up 200%. And you can see at the very end of this chart, super low numbers in a very small base. This chart gives us a historical context and an understanding of the incredibly low base. And yes, the foreclosures have definitely increased, but what this yellow line shows above the chart is the rate or the percent of housing units that are going through foreclosure activity. At the beginning of 2022, we landed at about 0.23%, which is significantly down from the Great Recession back in the 2008 years, where we were at a high of 2.23% of all housing inventory having foreclosure activity. Now, obviously, you wouldn't wish this on anyone, but based on a 250,000 homes or housing units here in the Milwaukee area, we potentially have about 1,000 foreclosure activities going on in our metro, and that would really account for probably less than 5% of our total inventory. So definitely we see an increase, but in terms of, you holding out and making your decision based on hoping to get a really good deal on a foreclosure, is kind of unlikely in today's environment. Foreclosures just simply won't be a big part of our inventory here in Milwaukee for two reasons. One, homeowners only sell when they need to in a normal functioning market. They will do whatever it takes not to be homeless if they have the means. Second, we're at an all-time high of homeowner equity, and households have a very healthy personal finance situation and balance sheet, meaning they have the money to keep on paying, and they have value in their homes, so they could just list it on the open market and not have to go through foreclosure and completely destroy their finances and credit score, especially when we have all these ready and willing buyers as well. Moving on to our next, big national headline that continues to get tons of coverage is inflation. We just got yet another good month of news based on inflation coming in lower than expectations for the third consecutive month. This data that we're going to be showing is from the U.S. Bureau of Labor Statistics. U.S. consumer prices climbed 6.5% in December from a year prior. Core inflation, which removes energy and food, had its first month-over-month decline since May of 2020 and also beat forecasts of being flat. To begin 2022, we started at 7.5% inflation, carrying over from seeing inflation that started all the way back in 21 and 2022. And we now ended the year at 6.5% versus the year prior. We peaked in June at 9.1%, but have seen a positive trend of inflation, both following and beating the estimates. Now, some extra info on the major categories that make up total inflation. First, food prices increased 10% over last year, driven by food at home, which typically has a strong correlation with gas or the transportation costs it takes to get there. The energy category increased 7% versus last year, driven by energy services like electricity and natural gas for your home. And then finally, core inflation, what we really look at because it's less volatile. Inflation rose 5.7% versus last year, driven by the things you buy every day, but especially shelter, which is sitting at 7.5%. One note here is that shelter percent change is very important as it makes up almost a third of the CPI basket, and it's likely that this is going to continue to drive inflation behind the scenes because it's super sticky, meaning because we do leasing for shelter, like the apartments you rent in 12-month increments and 12-month leases, it has a higher chance of sticking around longer. Now moving on to what happened in 2022 regarding mortgage rates. The state of the economy, of inflation, and the reaction of the Fed and the bond market are directly impacting what mortgage rates you receive from your lender. To start 2022, we were pretty much at all-time lows where as of December 30th, 2021, their average rate was at 3.11%. This marked the beginning of a historically sharp rise in rates as the Fed signaled a year of interest rate hikes. These are the rate hikes that banks lend to each other in order to provide loans to businesses and to essentially stimulate the economy. They raise rates in order to essentially slow down the overall economic growth in hopes of curbing inflation based on the wages that all these businesses pay on to their employees, which then gets spent on goods and services that we spend on every day. So through the Fed giving out the signal, the bond market, and more specifically the 10-year U.S. Treasury return, started to rise from 1.47% to 3.9% in October 2022, a very rapid increase in return. So the 10-year Treasury is regarded as one of the safest investments that the investor can put their money into and has an incredible correlation with mortgage interest rates all the way back to 1971. So almost a 40-50 year history of the correlation between these two. The spread between mortgage rates and the 10-year Treasury is traditionally about 1.25 to 1.75%, and usually they're tracking very closely to each other. As of October 2022, when mortgage rates were peaking around 7.1%, the spread was at about 3.2%, nearly double due to the risk that lenders saw in the investment of mortgage-backed securities. Now, today, a few months later, we're about 4 months later past October, that spread has dropped to about 2.7% or about 0.5% decrease. That's because we're starting to see a little bit less volatility in those rates and the Fed is starting to show maybe signs of not being as aggressive of their rate hikes, though we are expecting a few more rate hikes in the future as we come into 2023. 2.7% spread, with the mortgage rate being at about a 6.1% today, a strong improvement from October to November. And we're really expecting that with any signal that the Fed will reduce, stop, or actually decrease the interest rates would allow this essentially mortgage rate return to snap down closer to that historical correlation to the 10-year Treasury. And we could see rates as low as 5% in the year of 2022 or 2023. So how will we actually know when the Fed may finally ease up their mission to slow down growth of the economy? Well, I'm recording this on Wednesday, January 18th. I believe that the Fed meeting's coming up soon, and we might actually see a big reaction before this video actually gets posted. But what we're really thinking that they're watching right now is specifically the unemployment rate and the job report numbers. To start 2022, unemployment nationwide was at about 4%, versus to end 2022, we've actually improved to 3.5% unemployment rate. You can see on this chart we just pulled up from the Fred website, dating back all the way to the 1940s, gray vertical columns mark recessions. And recessions is when the Fed is typically going to pivot and start being less aggressive at either holding interest rates where they are or actually lowering rates so that they can again stimulate the economy again. Most recessions were marked by about a 4.5%, if not higher, unemployment rate. So the strong employment numbers is really what's largely keeping this mortgage rate in the 6% range right now, because we really don't know. Are we going to enter into a more aggressive recession in 2023 because the Fed has been so aggressive on raising rates so quickly? But in all honesty, they're keeping or starting to get some traction on inflation. Now we're just hoping that they don't have to go so far and to cause too much pain in the unemployment numbers. Next up, just for a quick pause, there's some of the national headlines that we've been following and a quick recap of what happened in 2022 and my thoughts for 2023. Do you have any other national headlines that you want more information on? Drop it in the comments below so I can make sure it's on my list of things to watch in 2023. And now let's dive into the year-end numbers for our local market here in Milwaukee obtained through the MLS. Starting with residential homes here in the Milwaukee Greater Area. Sold listings, 17,600 homes in all of 2022. Down 15% to 2021. So this is one of the big stats that you're seeing in the media is sales being down 15%. However, one of the big things that we're seeing that's kind of slowing down this traction is one, interest rates. We kind of just did a quick coverage on that. But then active inventory. Active listings, we ended the year at 1,900 homes, which was down 8% to December in 2021. Also, we saw new listings for all of 2022 decrease to 20,500 homes, down 12% to last year. The amount of new inventory coming to the market as decreasing definitely has an impact on what's actually available to our buyers. We've had super low months of supply, on average being 1.8 months over the 12-month average versus 1.9 months the year prior. We're just not seeing enough newness. We're not seeing inventory build to where buyers have enough options. Stack that on top of unaffordability with mortgage rates rising. Buyers didn't see a reason to go into a competitive market when they were settling and not seeing any new inventory that fit their needs. We're still seeing, a pretty consistent 20 to 30 days of days on market as well, which was super comparable to 2021. And finally, one of the key stats that everyone likes to keep an eye on, yes, sold listings were down 15% versus 2021, but our median sales price reached a peak of $325,000 in June 2022, which is pretty natural to see kind of a bell curve and a peak in prices in that summer timeframe, versus all months usually, otherwise being below $300,000 in 2021. At the very end of 2022, we did end at $280,000, but every single month for the most part, we saw a 7 to 10% increase in our median sales price versus 2021. So overall, still seeing home price appreciation in our Milwaukee market when factoring for seasonality. And then next up, just to give our investors a little bit of a deep dive as well, 2-family homes in the Milwaukee County area, sold listings, 2,000 properties, down 9% to last year. So performing slightly better than the residential space. Active listings, we ended the year at 240 properties, down 54%. There's just not enough investment properties in the 2-family space there for the demand that we have. New listings, 2,400 properties, down 23%. Definitely way lower than what we saw in the drop in sold listings. Months of supply, a pretty significant decrease overall, 1.8 months versus 3.0 months last year in 2021. Median days on market stayed about the same, but still very fast moving in terms of how quickly offers get accepted. 16 days in 2022 versus 15 days in 2021. And then finally, median sales price, $170,000 for 2022, down 3% to last year. I've noted this on a couple previous videos, but yes, we're seeing the median price drop here, but what we're actually seeing is with inventory being so low at down 54% to 2021, we're actually seeing a change in the percent of total listings over 180,000 come down in number of sales, and the number of sales in that lower price point start to rise or not be as heavily impacted. So prices 180,000 and less made up 53% of our sales in 2022 versus 50% in 2021, with sales being down 27%. Prices 180,000 and above made up 47% of our sales in 2022 versus only with 50% in 2021. We used to have a very even mix, with that being our old kind of median price point. We're just seeing that we're selling more and more of those lower priced properties just due to availability alone. And finally, a quick update on what happened in December 2022, because we still want to keep a pulse on what's happening each month. The Metro MLS December stats, I'm just going to pull up this chart that we get shared with each month and do a quick run through. Active listings, down 8.2% with about 1,900 listings available. Sold listings were down 34%, only 1,100 sold in December 2022. Obviously, a big part of this is due to not having enough inventory, and definitely what's not on the screen, new listing activity down significantly as well. Just not enough options available for our buyers. Next up, median sales price per square foot up 5% in the month of December, up to $170.20. Months of supply had a significant increase as a percent change, but our base was so drastically low coming into December 2021, 1.7 months versus 1.2 months last year. We still would love to see this number finally get up to almost double. Anywhere from 4 to 5 months of supply would be way healthier to where we could get a functioning marketplace here in Milwaukee. And then finally, our median days on market did increase 16%, up from 24 days to 28 days in 2022. All right, let's take a quick breather. Have I missed anything that's important to you? What do you need to know about the Milwaukee housing market? Or is there a national headline that you'd like a deeper look at? I'm here to answer any questions that you have. Just drop them in the comments below. And then finally, debrief. What does this mean for buyers and sellers? Let's summarize what is happening in the world of home buyers in 2022 and then what to expect in 2023. 2022 was an absolute historical roller coaster ride for home buyers. You saw 2% interest rates and you saw 7% interest rates in the same year. You saw every homeowner trying to list their home and capture opportunity to start the year, and then a steep fall off in new listing activity and new inventory coming to the market at the end of the year. You entered the year in one of the most competitive markets you've ever seen in terms of offers going over list price, and then a fall off once buyer demand paused when interest rates raced towards 7%. You've been bombarded with negative news with, will the younger generation of millennials ever be able to own a home with this competition? and then shifting very quickly and reversing to inventory bubbles coming and foreclosure spiking and rapidly increasing. So with all of this in 1 year, the volatility is incredibly difficult to plan around. As we enter 2023 and a new year starts, here's what I think you can expect from the housing market in Milwaukee. 5 to 6.5% mortgage rates, steady home price appreciation closer to what was the historical average, continued competition as buyers fight over incredibly low levels of inventory, hopefully increasing new listing activity as home sellers finally giving in to their needing to update or downsize their new spaces regardless of the interest rates, and a continuation of relatively fast-moving days in the market, but a steady increase of months of supply. If you need to upgrade your space, don't be fearful of our local Milwaukee market, as our current supply and demand imbalance should give our home values a really strong tailwind for years to come, which is really the correct timeline to gauge your housing needs and your budget and those considerations. Now let's summarize what we've seen this year for home sellers and what to expect in 2023. 2022 started off with the same craziness that we've seen since the start of the pandemic, but the shifts we saw through the year were the same mortgage rate changes that impacted all buyers also impact the majority of all sellers, because they're typically either move-up buyers or downsize buyers. Usually a home seller is also a home buyer. To start the year, price drops were happening on only about 2% of all listings, but near the end of the year, we saw this peaking around 5% of all listings with a price drop, higher than the last 3 years dating all the way back to 2019. We also saw median sales price growth staying consistent with the last 3 years throughout the year. So we're still seeing your home value go up relative to the seasonality that goes on in any given year. The average sale to list ratio also stayed elevated throughout the year, in line with what we saw in 2021 and 2020, and definitely higher than what we had back in 2019, meaning that most buyers were willing to offer over asking price. Over the last 3 years, home ownership and housing situations have shifted from what is needed to what is the best financial outcome, especially as rates spiked in dramatic fashion in 2022. As an example, how can I move from my $300,000 home with a $1,000 monthly principal and interest payment with 3% interest to a very similar home in a very similar area with one extra bedroom, because I just need more space, at $1,900 for principal and interest at a 7% interest rate? That just didn't make sense, and we called that the lock-in effect, where rates went from very low to very high in a very short period of time without having home prices come down with that unaffordability. What we should start to see is that relative to the recent past, sellers will get used to the higher interest rates, and they will be happy to buy at and be happy that they're in the 5s as opposed to the 7s. And historically speaking, being somewhere in the 5s is not bad. That is very close to the historical average, and we should see at some point in the future a good refinance opportunity in the 4 to 5 range as well. In Milwaukee, 2023 should be the year that you can go still sell your home for a great price and profit, especially if you bought at least a year ago and trade into the home you need for a historically average interest rate at 5%. As always, make sure to stage, get great photography, market your home well with a local real estate expert, and a compelling price that gets buyers into your home for in-person showings. So to wrap this all up, if you found value in the information I just covered here in the Milwaukee area for 2022 and what we think might happen in 2023, please subscribe and hit that bell notification so that you know when we post our next market update, as well as any other content that might help you with your real estate decisions in the future. Also, give us that thumbs up and comment below if you enjoy listening, or if you want us to add more details in the future. Thanks, and we'll be back soon with another Milwaukee real estate market update.